with interest rates dropping so low, that's why people are kind of jumping into real estate because it makes it affordable. But when they drop interest rates, prices go up. And so today, if you talk to most people, we're in a bubble. And that's the dangerous part because I'm not saying they will, if they raise interest rates, the bubble busts. And that's why I'm talking about liquidity. Liquidity is how fast can you sell it? For example, if I buy a new pair of, let's say, shoes, and I pay $100 for the shoes, how long will it take me to sell those pair of shoes? It will take me a while because nobody wants them. And it's the same with real estate. If people don't know what it feels like to have a piece of real estate nobody wants, for whatever reason, they don't want it.
Well, look at the commercial office buildings now. They're all empty. Yeah. If you can find a way to repurpose them, great. That's what's needed right now. But I wouldn't want to own a big office building right now anywhere.
No, you have to, I highly suggest, because real estate is, once you buy it, you bought the Titanic. It'll either take you to heaven or it'll take you down to the bottom of the ocean. And thank God we've never had that happen to us. But also what happened was when Kim, as we got more successful buying the property, and Kim was the property manager. And then what happens, property management consumes you. Mm-hmm. Just like your dad said to you, I don't want to fix toilets. And well, nobody wants to fix toilets, but that's what the property manager does. Plus, it's a contractual agreement between you and the renter. And they can violate, they can trash the property. We've had property managers steal from us. It's just one big zoo. It's a Jerry Springer show on steroids once you get into property management.
And it's harder. It's harder to self-manage your properties, but the education and the knowledge you get, because even when we had an on-site manager, we're still the owners of the property. We still make the final decision. I'll never forget many, many, many years ago getting a call at 11:30 at night, and this tenant was trying to move out with our stuff. It was a furnished house. They were taking the refrigerator, the stove, and the police had to come. And it's like, I look at that experience now, I wouldn't trade that for anything.
Something's wrong when there's a U-Haul in front of your rental property at 3:00 in the morning. So at Rich Dad, we always recommend you learning by experience to do what you do. And then you can go through the process because it's a process. So let me say this much is the easy part is raising the money. The hard part is managing the property. And I think that's what people forget because when Kim and I first started out, the managing a property is the biggest business of all. But if you're just a mom and pop, you can only manage so many properties.
So when we met Kenny, we were managing, our biggest property we had was about 35 units. And we couldn't buy anymore because I couldn't manage anymore. I didn't have the time. And so I was so happy to find Kenny because Kenny's philosophies in real estate and cash flow are totally aligned to ours. And we're like, oh, good. Can you start managing our properties? And he said, no, I can't because I only do 150 units or more in management. And at that time, they were just property management. Now they're doing development and, of course, acquisitions. And so that forced us to up our game and to find a 150 unit property. And then he and his team manage that for us. And they have since they're managing all our properties today.
So we're now up to about 10,000 units. So he's very similar. Kenny McElroy is very similar to Grant Cardone. If you don't want to manage and find and go through the headaches and the legal battles of property, then you give Grant your money and he'll do it for you. It's the same as Kim and I right now. We just call Kenny up. See, we need debt. This may not make sense because Tom Wheelwright's book, Tax-Free Wealth. We need debt to offset our taxes. It doesn't make sense to most people. But I'll call Kenny. I said, Kenny, I need about $20 million in debt. So he'll buy a property and borrow the $20 million so I can amortize and depreciate the property. That's the game of real estate. So Grant Cardone does some things very similar to what Kenny does, and I would recommend investing with Grant then if you're so inclined. But you still have to do your due diligence.
You still got to do your homework.
Yeah, you still got to do your homework. But real estate is not like a mutual fund or a stock or a bond. You buy it, you own it, and if you make a mistake, you really own it. Nobody else does. That's why. So real estate is a very different game. We love the game. It's the best game in the world, but you have to decide, do you want to be good at it, or do I just want to give real estate my money to somebody like Grant Cardone? And that's the big difference here. because this is the big difference with real estate. It's not liquid. And liquidity is one of the biggest things you need to realize when you're investing. For most people, they should just buy a mutual fund, and if it's, or a stock or a bond or an ETF. The reason for that is because paper assets are liquid. You make a mistake, you make a mistake in the morning, you can be out of it that night. You make a mistake with a piece of real estate and it's a really bad deal, you write that sucker down. Or the mistakes just pile on. So in real estate, the most important thing, as Grant says, is how do you find it, how do you finance it, and how do you manage it? Those are the three pieces. If you make a mistake anywhere along those lines, you get crucified. So the word is liquidity. I wouldn't recommend starting with a 200-unit apartment house because you make a mistake. I don't care how smart you are, you'll still make a mistake.
A lot of people don't understand is what is a good deal? What makes a good deal? What makes a bad deal?
Yeah. And how do you manage it? How do you finance it?
How do you manage it? How do you finance it? So one of my questions is, like, for example, for us, when we're looking at property, we always want to go where there are jobs, which is a little more tricky today than it used to be. But that's a criteria, because if they aren't working, they can't pay rent. So I'd like to know from you, Grant, how do you tell a good deal? What's your criteria for a good deal? And what are the mistakes of a bad deal?
Here is that everybody has a different formula. As my rich dad always said, there's a million ways to financial heaven and a billion ways to financial hell. And right now, many people are going to hell because they really don't know what they're doing. Without financial education, they do not do. So back in 1996, Kim and I created the cash flow board game so you could understand how financial statements work: income statement, balance sheet, statement of cash flow, the difference between employee mindset, self-employed mindset, big business mindset, and investor mindset, and all that. So we're just purely educational. And I'd be upfront about it. Grant recommends you just start at 200 units with a partner. I don't recommend that. I mean, you can invest with him and do that, but I would personally not do that. So Kim, why don't we just start with how you got started? Because, I started in Hawaii, and then I started teaching. One of the most dangerous things, they say you never teach your wife golf, and don't teach her about real estate either. But when I introduced Kim to real estate, she took to it like a duck to water. But you started really, really small, didn't you?
I did. And I think one of the differences in our philosophy versus Grant's philosophy is we're about financial education. And the best way to get educated is to get hands-on and to get in the game. And so I think for me, and for you and me, Robert, for somebody to start on a 200-unit building with a partner, the education is going to be very, very, very different. And to me, that's very risky. So we're all about starting small, get the knowledge, get the experience, get the education, and then build from there. I think that's just a difference in philosophy. And
have we had problems with partners?
Oh, yeah. Especially when it comes to money. I mean, money is a psychotic subject. And so if you're only going into real estate for the money and the return, then probably Rich Dad is not your philosophy to follow. Right. But if you're in it for the long term, for the education and to grow it and to hang on to it, then yes. So as you were saying, I started with a little 2-bedroom, 1-bath house,
Portland,
Oregon, $5,000 down payment on a $45,000 house. Nervous, scared about making a mistake. What if the market turned? What if the tenant moved out? All of that. But it was these small properties. Then we went from, another single family, went to 6-plex, went to a 12-plex, went to an 18-plex. And every time, more mistakes, more learning, more knowledge. But now we can do the big deals because we've got that foundation of education and experience behind it.